Hello there, this is James, and you're about to watch the latest episode of our webinar, latest episode of our webinar series, Primus Live. Now, we're about to start in about 3-4 minutes. I am excited. I hope you're excited too, and I'll see you soon. Hello there, this is James, and you're watching the latest episode of our Primus Live webinar series. Now, before I introduce you to my very special co-host, remember, these little episodes we do are for educational purposes only, and in no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let me give you a brief introduction to my very special co-host. Her name is Kaia, and she is our head of investment research here at FX Primus. Before she worked with us, she was a portfolio and investment manager with exposure to both public and private markets. Before FX Primus was lucky to get Kaia, she was a senior investment associate at a hedge fund in Singapore and a vice president at Bank of America Merrill Lynch. Yes, welcome, Kaia.
Hello, James, Kaia. Hi. How are you? Good to be with you again.
Always a pleasure.
It's always a pleasure.
Yeah, always a pleasure.
I love how we are color coding today, both in blue, so well coordinated, my friends.
Absolutely. Well, I tend to wear blue a lot because apparently blue brings out the color in my eyes. Somebody told me. I think they were after something. I think they were just trying to charm me, but I do like blue anyway. So anyway, my darling, how's your week been? How have you been?
Week has been great, and it's been very pleasantly uneventful.
Okay,
Meaning that we have the new administration in office. Markets are sort of acting calm again. We are not seeing a lot of volatility arising from different tweets or any sorts of unusual presidential behavior, I would say.
Yes.
So I'm definitely enjoying the quiet week and, maybe easing into 2021.
That's absolutely right. It's almost gone back to normal, hasn't it? Normality. And to be fair with you, you just saying that, I just suddenly thought, do you know what? This time last year, okay, we had something that happened on the 6th of January, but now we've got a new administration in. This time last year, there was constant sort of news and tweets and things and stuff like that. And I've completely forgot that we don't get that anymore. And it's really nice. It's a little bit like, it's really nice. It's like when you've been in a rave or a disco and the music has been so loud and you leave it and it's just quiet. And you're like, do you know what? I can have a conversation with my friends again. Nice quiet, and I can actually hear myself. So you're absolutely right. It is brilliant. But anyway.
So, but on the tweet topic, Joe Biden has started tweeting, and these are extremely boring tweets, which have been great.
Yeah.
No news and no new announcement, no policy, updates, nothing. It's just boring tweets, which markets are loving.
There you go. You said it's boring. I haven't even thought about it. I haven't even noticed the Biden tweets. But anyways, yes. So yeah, it's nice. I'm enjoying this normality as well. It's an easy way to adjust in to 2021. Now, obviously, we've got a really interesting topic we're going to be discussing a little bit later. But as usual, do you want to start off, just have a little conversation about what's happening currently in the markets?
Yes. So just to give a bit of qualitative data, there's nothing much happening on the markets, except for, I would say, a few interesting developments here and there. So looking at the equity markets, risk on has been definitely the sort of key theme up until today. Today definitely is a bit risk off, and most likely that's for two reasons, I would say. Firstly, market do need a bit of a breather, so every now and then we have a bit of a pullback. And secondly, today is the day when the Federal Reserve Bank is going to announce their interest rate decision, and also they are going to update their monetary policy statement. Normally, I mean, at this time, there will be no major news coming out from the Fed. We know more or less what the interest rate is going to be. It's going to be zero low bound up to 25 basis points. But everybody's definitely keeping an eye out for any hawkish type of commentary coming from the Fed, especially around inflation. And a couple of Fed officials, I think Kaplan being one of them, have mentioned if inflation should pick up and persist to be higher than 2% at least 12 months in a row, they could discuss, perhaps raising rates slightly earlier than 2023 that was initially mentioned.
Right.
So that was something that definitely caught my eye because I think the market has been operating under the assumption that until 2023 there will be no interest rate hikes. But definitely market participants are keeping eye now on PCE, which is the inflation measure that the Fed prefers to use over CPI. Okay. And there has been a couple of spikes in producer pricing, meaning those prices that are used, or not, let me rephrase, those prices that reflect the cost of input for the goods that we actually consume. So these prices have been creeping higher for a few reasons. First of all, it's the cost of energy that has gone up. Oil prices have spiked. And secondly, it's also the shortages in labor markets. So in US, although you have a lot of people who are unemployed, you also do have a problem when it comes to actually getting people to do the work because certain groups are not in the job market anymore, or they're not available for a number of reasons. And, COVID and lockdowns are part of them. So, inflation may creep up in places we didn't expect it. And the Fed may discuss actually hiking rates.
Yeah, so they're looking at really for the very hawkish comments today with a hint. Like I say, we all know they're not going to do anything, obviously, today, interest rates. So it's all about the hawkish comments. They may mention the fact that they may be able to pull the trigger and act before 2023. We also have US GDP tomorrow, I believe, as well. I don't think that's going to be a major market mover. To be fair, I think we've already, like I said, we've already said fundamentally the market is sort of ignoring a lot of this financial data really as it currently stands.
And for the USD GDP, we know it's going to be negative for Q4 anyway. I mean, PMIs have been slightly better than expected, but looking at retail data, I think it was down 2.3% in Q4. So again, that being such a huge component, I would say that GDP definitely is negative. I think the estimate was maybe 3.2 for 2020. So we shall see. But again, you're 100% right, James. They will probably not be any huge market moves based on these data points.
Yeah, probably. And we've got earnings obviously coming up on the next couple of sessions as well. So I think a lot of market attention will be sort of focused a lot on stock performances, because we've had a lot of stocks surprise a lot of people over the last couple of trading sessions, GameSpot being one of them. AMC today, the cinema chain, which is just skyrocketing things. So I think that's going to be something which is going to be on a lot of traders' minds today. Will be obviously be in earnings, but overall, pretty, like Twitter, apart from a few spikes and a few rises, pretty calm.
Pretty calm, yeah. But the earnings season will be interesting this round because, I mean, I think at this point, maybe 15% of S&P 500 companies have reported earnings, and about 86% of them have had surprise on the upside on their revenue. So 86 is unprecedented. Again, another unprecedented thing that has never happened. But that's coming from the very low base that we had in 2020. So I think everybody just lowered their expectations to extremely low base. Yes. And now you keep seeing those surprises coming out. But yeah, I mean, 86% companies positive surprise on the earnings, on the revenue side, and that will trickle down to the bottom line as well on the earnings. So maybe we will do one sort of summary session in a couple of weeks when we have more companies that have reported their earnings, and just to go through, you know, what's actually happening at the corporate level.
Yeah, perfect. And like I say, yeah, definitely. It'd be nice to do a little bit of a follow up and see where we're at with that. You know, and it'd be nice to see certainly where GameSpot and maybe AMC is, because they've been taking a lot of headlines and surprising a lot of people. In your opinion, obviously, do you think, because obviously with AMC, they're having the stimulus bailout from the government. It was very similar to what you said, was it last week or the week before about Hertz? It's the same sort of scenario, isn't it? When Hertz got bailed out, the market jumped in, and AMC, what's happening to AMC is clearly something similar, isn't it? Wouldn't you agree?
100%, it's effectively saved basically by speculative flows. And I put out something on LinkedIn today, and also on Twitter. It's a lovely chart that shows where the savings are going. So, you know, we have discussed this savings rate being slightly higher since April. I think it reached 33% in April. It has come down to 13% as of October versus the long-term average about 7%. So apparently all the money that goes into stock market actually is considered as saving in the sort of GDP composition. And it shows that the middle class is putting a lot of money into stock market. So whenever somebody asks, why do we have such hype in GameStop or AMC or whichever sort of bizarre equity, I think you can point to that particular chart and say, you see, middle class is putting money into stock market. So it's a bit of speculation, I would say.
So that's what it is. It's interesting. So like I said, is the average Joe, you're saying, then sort of the middle class segment with savings are putting their money into something.
It's the middle class, exactly.
Yeah, it's the middle class, which is a good thing, obviously. It means
which is a good thing, of course. Yeah. I mean, again, good thing in a way that better than spending money on completely random stuff, I suppose.
True.
But on the flip side, if the valuations do not make sense at this point, and I would say that consider global market capitalization versus GDP, again, historical high of 200% versus long-term average of 130%. I think it's safe to say markets are overvalued. If somebody puts their savings into stock market on the basis of maybe fear of missing out, I don't think that's maybe the wisest thing to do. And also the same chart showed that really the top earners are not putting money into equities market. So really is the middle class.
It's the middle class. Because that always reminds me of when just what's sad about the history, go, think about history. The 1929 crash. That was one of the big things. Was we had a lot of, because everything was booming back then. A lot of the
Don't
average
say
Joes
we weren't around. Don't say we.
Like I say, there was a lot of. No, I wasn't around, obviously, back in 1929. I'm not that old. So I read about it. Okay, I read it in a book. I do read sometimes, but I do remember that one of the big issues with that. I'm not old. 1930, I was born. Okay, a year later. No. Anyway, back in 1929, because of the big before the crash, the market was booming, and a lot of average Joes and people not familiar with investments or trading invested their money in, and that's what really caused the huge crash and the huge amount of people losing out. Touch wood, something like that doesn't obviously happen this time around.
Yeah, I mean, bubbles are always, very obvious in hindsight. But once you're in the bubble, it always feels good, and it feels, sort of, oh, it's going to go up, and we witnessed that in 2008 with the mortgage-backed securities. True. So again, I guess we will have to see in the future how this sort of speculative mania is going to end up. But yeah, I have a feeling that a lot of people are going to get their fingers burnt properly.
Yeah, I would agree with you. GameStop and let's see what happens at AMC, certainly in the midterm. Anyway, there's a little chat about what's going on in the markets and what we miss and what we don't miss, obviously, with Twitter. So we move on to our big subject of the day, which, of course, is currencies.
Currency pairs. So we have gotten a lot of comments from our viewers about trading majors, trading minors. So first of all, we would like to sort of give a bit of framework around what is a major, what is a minor. So major currency pairs or majors are considered those currencies. Sometimes they're defined as G7. Sometimes there are, slightly broader definition, because within G7 you have multiple European countries. However, these are those currencies that have the deepest liquidity. Therefore, they tend to have the lowest spreads. And also, since these are the countries that have the world's biggest economies, they also have the highest amount of capital flows. And what I mean by capital flows is that you have those natural demand and supply for that particular currency. And let's just go into a specific example. So let's take Australian dollar. Australia being a major exporter of various things, among them commodities such as gold, such as iron ore, but also stuff such as education and also tourism as such. So you would always have people who want Aussie dollar or who want to sell Aussie dollar. So that's what I mean by natural demand and supply. You don't need to have speculators. You don't need to have market players to sort of prop up that liquidity. You always have some sort of market activity happening around these particular currencies. And when I talk about minors are those currencies that, first of all, economy is smaller. I'm not going to say always the case, because China clearly is the world's second largest economy these days. But also these are the currencies that have lower liquidity, subject to opening hours, meaning when actually these regions are actively trading. So again, great example would be, for instance, Singapore dollar. Singapore dollar liquidity clearly is the highest during Asian trading hours. If you want to trade that 4 p.m. GMT, then Sing dollar, it's nearly impossible to find liquidity with a reasonable cost or with a reasonable spread. On top of that, these currencies sometimes may not be freely traded. You may have central bank intervention, and I know a lot of the viewers may debate and have an argument, but what do you mean? US dollar also has intervention from the Fed, but not to the extent that they actually determine the FX rate. So there's a lot of speculation, for instance, around Chinese renminbi or CNY yuan, depends if it's offshore or onshore, that the People's Bank of China wants to has pegged that to US dollar, and it's keeping that moving in a fairly tight range. And it's very obvious if you look at the chart. I mean, you can see how time series sort of moves in a very controlled manner.
Yeah.
And of course, when you have lower liquidity, you're going to see choppy charts. You're going to see a lot of big gaps for opening, close, and sometimes speculators do move the markets, as we have seen, for instance, with lira, Turkish lira. We have seen that with Argentine peso. Of course, you can also break the Bank of England if you are wealthy enough, as George Soros has famously done. But point being is that the sort of liquidity and the availability of funds is lower for the miners, which means the trading can be and is more risky. And sometimes it's better to build out a bit longer term strategies, not to trade intraday, but maybe trade over the course of multiple days, weeks, or sometimes even months, if you see thesis that may be valid under your assumptions.
Yes. What do you trade out of do you trade any miners, or do you trade many majors out of interest?
Only majors, and that's just personal preference, because miners, they do require certain skill.
Yes.
They require really, I wouldn't say to be an expert, because again, the same sort of logic applies, but it's just a personal preference.
No,
I
agree. I mean, I'm a major man. I do trade the majors mainly, but I have known in the past, I have traded like Cesar and the NOK a couple of times, but I'm not frequently trading those pairs. I'm definitely more of a cable, euro, and euro yen type of guy. So those are sort of ones I tend to focus the majority of my time on.
For sure, and just to add on the majors versus minors, so I guess the common sort of convention is to quote the minor versus a major. So for instance, you would see USD CNY, you would see USD NOK, but it also can be that a minor is versus a minor. So for instance, Swedish krona is pretty often to be traded against Norwegian krona. So you do have those regional pairs that have very strong correlation, and which economies are perhaps very intertwined, I would say. But the same goes for majors. So Aussie Kiwis is again a huge pair, because these are just economies that are so closely linked to each other.
Yeah, of course. Yeah, so like I say, so there is similarity between the two. Both have its own sort of benefits and comes with its own sort of risks. Certainly the miners consider it are more expensive, as you said, because of the spreads, because they're less liquid, and can be a lot more choppy and a lot more volatile. So you do need to sort of handle with care. Plus, at the other side, majors, you can trade them pretty much 24 hours a day, Monday to Friday, whereas the miners, they are restricted to certain trading periods of time. So that limits your time when you can open and indeed when you can close a position.
Yeah.
So yeah.
And also on the minor side, you can never discount. I shall say the unexpectedness factor, which again applies also for major. But when it comes to minor currencies, there you always have to look at the sort of, let's even say, the political environment in that particular country.
Yes.
You have to look at any major announcement that may happen, because let's say inflation announcement could have much more impact on a minor versus a major. So again, we have discussed this a couple of times, that these days nobody even nobody even reacts to, let's say, non-farm payroll data. They're like, whatever. But similar data point in another country could actually move the markets. I'm not saying it's jobs data per se, but just the economic data point that maybe offers upside, downside surprise could really move a minor.
Yeah, and you can have like I say, with the miners as well. Again, it can affect the majors at the same time. Politics can be a major influence as well.
Sure.
I can think of an example back in 2000 and when was it? 2017 in particular, where you had the change in economic minister in South Africa's government. I've forgotten the gentleman's name now, but that happened. The Tsar came under a huge amount of pressure, big moves, which you probably will not see, or potentially might not see as much with the major. So the politics behind certain things can be a lot more dramatic. And
lira is the same. I mean, we've seen all the political theater, happening in Istanbul, whereby President Erdogan does not believe in inflation and believes that lowering interest rates is great during inflationary environment. So lira, I think, is one of the great examples for, in general, currency trading textbook. because there are just so many examples that the Turkish lira represents, and we're gonna, touch upon lira a bit later as well. But in general, there's just more details and more angles to consider when you trade minor, especially if your strategy is for longer term.
Yeah, true. Very, very true. Very true. Right. So should we move on to the next slide?
Yeah. So I just wanted to talk about USD as a reserve currency as well, because first of all, we can't get around USD being in FX business. That's something we quote at least 100 times per day in one context or the other. But a few interesting data points I was able to find online about USD. So everybody knows it's the global reserve currency. So what does that mean? What does it actually mean? It means that the central banks all over the world actually hold dollars in order to build trust in their own currency, I shall say. So if you have like a reserve of USD somewhere on hold, you always know that you can protect or you can defend your own exchange rate. And looking at the numbers, we see that 60% of FX reserves are held in USD. And the next one is Euro with only 20%. And this very commonly quoted CNY or Chinese renminbi, it's only 2%.
Yes.
So it really shows the dominance of US dollar, although it may be diminishing, but by the time that it's actually completely gone, I don't think you and me will be around anymore. So
no, I think you might be, but I definitely don't think I will be. But yes, you're right. It's been, like I say, it's been the dominant ever since the end of World War II. It's been the major.
Correct. Yeah. I mean, I suppose it was really. I mean, end of World War I, when already the dollar was the main trading currency. But I think after the UK finally came off the gold standard the second time, the US dollar just completely started to dominate, and Bretton Woods arrangement basically, just paved the way for the situation we're in right now. Yeah,
definitely. I guess I say, but up to this, sterling was for way back, and obviously the dollar replaced it, and sterling was second to how I remember. And then the Deutsche Mark replaced it, which then of course was replaced by the euro. But like you said, the greenback, which I like to call, it's my little, it's the main nickname for the dollar, will pretty much stay number one for certainly for the remainder of my lifetime, I expect.
And dollar is 85% is the counterparty for FX trade 85% of the time, which again shows the dominance, how much trading is done in US dollar. And when we say FX transactions, these are not the FX that are done for speculative purposes or even for investment purposes. These FX transactions done to buy something from the US, buy a car or sell something. These are really the major capital flows that are used just for the economies to operate normally. So the speculative flows are a very small portion of that. And 50% of trade is in USD. So what does that mean? It means that, let's say, if Zambia wants to transact something with China, most likely they will not use Chinese yuan. Most likely they will both use US dollar. At this point, there is a lot of discussion. What's Russia doing? What's China doing? What's Iran doing? Because they want to get out from this US dollar system, which means that payments are settled in SWIFT platform, and you can very easily just leave out counterparties you don't want to interact with. So there is a bit of tendency or trend to move away from US dollar as the main trade currency. But again, it's such a long process that I think is much stronger force than a few central banks deciding that they want to do something in other currency.
True.
And also the loans and interest payments are mostly done in US dollars. So why is this very important? So the world is massively short of US dollars. And what I mean by that is that so many loans, as it shows here, 50% of cross-border loans are made in USD. So somebody owes somebody USD at all the time, plus interest. At this point, there is not enough dollars in circulation to pay back all that debt. And when you have liquidity crunch, what's going to happen is that dollar is going to be very strong. And we saw that in March 2020 when dollar spiked. And the main reason was that the countries who need to buy things that are in US dollars, such as oil, for instance, if they can't get their hands on US dollar, you're going to see the FX rate spiking a lot.
Yeah,
so in the situation of crisis, US dollar is the first to show that, oh, we're going to have trouble at some point, because the rate is going to move fast and in directions that you may not even expect sometimes. And again, 60 countries using USD as legal tender or pegged to USD.
Yeah.
So that also sets sort of the floor always on dollar exchange rate.
And finally, global commodities are priced in US dollars.
Commodities,
gold, silver, oil, as you've already said. All the major sort of precious metals, etc. Soft commodities as well. So yeah, the global commodities all priced in greenbacks.
In greenbacks, indeed.
Should we move on to some sort of trading strategies here? There's a couple here.
Yes, so we've just highlighted a few, and we can talk about this for hours. This is very, very personal, I would say. Depends what somebody prefers to trade. Yes. But just in broad strokes. So Japanese yen and Swiss franc are considered to be as safe haven currencies. Yes. What does that mean? This means that whenever times are bad, when there's some sort of stress in the markets, people would investors want to park their money somewhere where they know that the principal at least is safe. And these tend to be Switzerland and Japan. Switzerland, for historical reasons. Nobody's going to go and touch Switzerland because half of the world gold is just stored there and be in peace. True. And Japanese yen is for other reasons. First of all, Japan is extremely stable economy. Japan has, I would say, negligible inflation, not to say deflation, because they do have deflation, which means that there's almost no chance that the yen is going to lose value arising from inflation. So you always would have some sort of, safe haven. And, for those traders who know about cross-currency swaps and also the yield spreads, they also know that how much speculation is happening around yen and, let's say, US dollar or Aussie dollar exchange rates, or I shall say yields on the government debt. Though CAD, Norwegian krona, very obvious, driven by oil price.
Yes. Both oil producers, aren't they? So that makes perfect sense why they're obviously their currencies are linked to obviously where oil prices are currently.
Yeah, I think Norway, is trying hard to sort of step away from that dependency, and they are trying to produce less oil and actually focus on other industries. But again, for the foreseeable future, it's going to be definitely oil-driven currency. Yeah. Whenever you see oil prices spiking, you're going to see that currency performing better, and vice versa.
Yeah.
Aussie Kiwi, I would put into the same bracket because these again go hand in hand. Really strong currencies. They are commodity producers. Whenever you see a sort of uptick in commodity prices and in global trades, you would see these currencies doing extremely well.
Yes.
Australian dollar driven a lot by China, especially since early 2000s when China started their construction and manufacturing boom. Yeah. With everything,
they're the biggest trading partners between. China's Australia's biggest trading partner, isn't it? So
correct, imports and imports, by the way. So it goes both ways. So it's not just Australia exports, but they also import a lot from China. And it's not just commodities; it's also cattle, for instance. It's wine, for instance. And it's also education. So Australia is one of the key destinations where Chinese want to go get their degrees on top of US.
Got it.
But I'm sure you know also about the latest tension between China and Australia. It started, God knows already when, but a few highlights were the Huawei ban and also the coronavirus sort of situation. Australia was the first country to point fingers at China, saying that you guys are not giving us all the details. So China is very actively trying to sort of push Australia to the side, become more self-sufficient when it comes to commodities. And they've also slashed tariffs on Australian imports.
So their like little friendly relationship is finally getting a bit frosty then, by the sound of things then.
it's getting a bit of frosty, and Australian government has said out loud that we have become a bit too dependent on China. We need to be more self-sufficient and think of other ways how we can diversify. So Indonesia is their sort of next key, because they want to export there as well. Then ZAR, clearly South African rand. They produce again commodities, gold. So again the same risk on sort of commodity-driven currency. And I'm mentioning here Turkish lira and Argentine peso. So these two currencies tend to be a bit of like, what's the expression, canary in a coal mine.
Right, got you. Yes.
Meaning that these two countries have double deficits. They have a current account deficit and they have fiscal deficit. So meaning they are extremely dependent on capital flows coming into the country, in particular USD, to finance their own activities. So what we saw back in, now I have to think about the year because 2020 seems like a very long year. That must have been 2018, early in September, when both Argentine peso and Turkish lira came under a lot of stress. I happen to know that because I was working with a Turkish fund and Argentine fund that both went under for the same reason, so slightly traumatizing. That was fun for sure. That was fun because what happened was that when you had invested money, especially US dollars, into Argentina, the government said, "Nah, we have capital controls. Sorry, you are not getting your money back. Maybe next year."
Yeah, if you're lucky.
Maybe next year.
Yeah, it's in the post. Trust me. Yeah, that's sort of
it's somewhere, exactly.
Yeah, I got you.
So these two countries are very good indicators for, in general, I would say, emerging market stress.
Right.
But in broader strokes, credit risk and liquidity crunch in the system.
Got you.
So whenever you see, risk off mode, lira and peso definitely will feel the pressure pretty fast. Okay,
so they're a good indicator to keep an eye on. Sort of almost act as an indicator of the overall story going on in emerging markets. Then,
for sure, they will be the first ones to show signs of stress, and more likely than not, you are going to have spillover to other emerging markets. And again, you would have, in order to identify which countries, I would highly recommend looking again at current account deficit as well as fiscal deficit, because these are the two sort of big buckets that need some sort of funding. If you can't fund it yourself, you have to get money from abroad. So Russia is also another interesting one, which I'm not going to talk about, but I'm just going to mention here.
Got you. So in a nutshell, there's a couple of things I like to mention, but in a nutshell, what we're saying, obviously, if you have a risk-off appetite in the market, when the market is very, the sentiment is bearish, look at pairs like the Japanese yen, Swiss franc. When you're seeing potentially high oil prices, Canadian dollar, the loonie, obviously, and the NOK can also be a big potential to watch out for. Again, when you have risk on the market, and you have a bullish momentum, the Australian dollar, the ZAR, and the Kiwi, because they're basically the risk on, and they're obviously commodity-based currencies. Aussie dollar and ZAR in particular, watch out for when gold prices are on the move. And the TRI and the Argentinian, are ones to watch out for, to really give you indication when the emerging markets are either about to sort of start really struggling or start about to go up.
Yes.
Perfect. One of the pairs I like to, actually, one sort of currency strategy I like to do, and I think in the future we should definitely do, and we definitely will do, an episode on correlations. Okay, but this particular strategy I do, which is two pairs actually, which are both negative correlated. What I mean by that is they basically should move in the separate direction to each other. Okay, positive correlation means the currencies move in the same direction, as we know. Okay, now this particular strategy I tend to trade the euro sterling. Okay, but I then hedge it with a guppy trade, which is the British pound Japanese yen. Okay, because they're negative correlated. And the sort of thing I tend to do, and it doesn't always work. So remember, ladies and gentlemen, this is not advice, this is opinion only and just something to share. So don't trade it as trading advice. Is what I tend to do is, if I've done my analysis on the euro sterling and I think the euro sterling is going to move higher, I open a long position on the euro sterling, like a larger contract size. And to hedge myself, I do a long position in the guppy, but a smaller contract size. with the idea that if I'm right, obviously my loss on the guppy trade will be covered by my profits. And if I'm wrong on the euro sterling, I don't get wiped out totally and I get something back from my guppy trade. So that's one particular sort of currency strategy I tend to do. And like I say, it doesn't always work. It's not trading advice. So there we go. If you want to practice it on a demo. So yeah, that's one thing I tend to do. The other thing I look at is if I'm looking at the euro dollar and there's a high amount of volatility in the euro dollar, if I'm feeling a bit braver, I might also do a euro yen position at the same time, or trade euro yen based on where the euro dollar is going, because those two pairs are obviously positively correlated. And the advantage of doing the euro yen is it tends to move a little bit sharper and quicker, so you can get a lot more volatility in that pair, which means bigger potential profit, obviously, but also if you get it wrong, also bigger potential loss. Just to cover myself, but that's to the pairs, sort of 4 pairs in particular, 4 strategies I tend to look at.
Yeah, I mean, although from statistical analysis perspective, the movement of FX exhibits random walk, which those people who do statistics know that it's nearly impossible to predict actually the movement of FX just based on statistical tools. Nevertheless, a lot of these pairs actually do exhibit some sort of time series correlation. You see, patterns repeating, and that's why we use technical tools to predict and perhaps describe what's happening on the markets. So certain pairs tend to either have positive correlation or negative correlation, and that can be used for your advantage if you know what you're doing. So, but again, correlations are interesting thing. It sounds a bit weird, but they only work until they don't. And what I mean by that is that correlations break down, or they go all into they converge into one when you have stress in the markets.
Very much so.
So whenever you have stress, correlations are just completely messed up.
Totally. That's why it's always a good idea to obviously look at the correlation table to see, if the percentage of correlation is changed, either the negative or the positive, and keep up to date with that. The other thing I tend to find, and I made this mistake once when I was doing the euro sterling guppy trade, one of my trades there. I was I was doing quite well with it. It was hedging me quite well, and I was getting quite successful. And then it didn't work as a hedge, and the reason for that was, not like I say, it always does work, but in particular, I didn't focus on what was going on in Japan. I was too busy focused on the euro sterling, what was happening in the euro and the UK, and basing my judgments on that. I didn't pay attention to data come from the Japanese yen, so it was a complete disaster, a complete waste of time by mine. That was completely my error for not looking at the overall picture. But anyway, lesson learned.
Lesson learned, of course. And about Japan, what just popped into my mind was, we talk about the political situation being a driver for the miners, but it can also be for the major. So, the previous prime minister, whose name I've already forgotten, see how great memory I have, when he stepped down, I think in September, yen actually got stronger. And the assumption was that perhaps you're going to have less stimulus, because there used to be just a lot of stimulus in Japan, in the form of the Bank of Japan actually stepping into JGB market, which 50% is actually on their balance sheet, and 6% of the equities market. Assumption was the new PM Saga-san, I think, could actually maybe be a bit more conservative, but nah, it's the same basically. So politics can actually play a role for the majors as well, and we've seen that with US dollar and Mr. Donald Trump.
Yeah. And obviously the cable and the UK and their complete mess of politics.
Yeah.
Anyway, let's move on to some questions. We've got some questions already sent in. It's very. I picked a couple of questions very similar to our topic today. Those kindly have sent questions in already. What we'll do, I'll keep them, and obviously talk about them when they're related to the subject matter, which we're doing. But this is a great question. It is how to trade news, and how is it understanding how it will affect a particular pair. So, as we're talking about currency pairs, how can news affect a currency pair? I think we've covered a bit of this already with some, but
long debate what came first, whether it was the chicken or the egg, if actually news move the market or markets move the news, right? Or rather saying move the news, but I would say they are the reasons why certain articles are being published. And actually general consensus is that it's the markets that move first, and then you generate news after that, because human brain works such a way. We always need to have a narrative, right? Oh, the market moved today because of this. The market moved because of that. You don't really know why the market moved.
I get it.
Big pension fund could have, liquidate one of their positions, and we're all talking about, risk on sentiment. So coming to the question, how to trade the news, I think it's better not to say anticipate the news, but at least when it comes to certain data points being published, it's always good to have a view. So let's take the most basic example here, US GDP. If somebody has very strong conviction, I think the GDP is going to be better than the market expects, I'm going to go long dollar, for instance, because dollar may gain. So trading the news may be a bit reactive. You may want to be a bit proactive in terms of looking what's going to happen on the markets.
I think actually you said this at the very beginning. When it comes to trades, in my personal experience, it does depend on what story the market tends to be focusing on at the time, and it's only ever focus on one story, be it unemployment, be it this, be it that, and then all the news related to that is what the market is sort of focusing on. But as you said earlier on, and I think when you're looking at the news, certainly you've saved like the interest rates like today. You said it earlier. The market's not really going to be paying attention to the interest rate decision. What they're going to be paying attention to is the hawkish comments. So really, when you're looking for and stuff like that, it's not what the news means right now, but what something what the Fed or the Bank of England or ECB might do in the future, which can have more of an impact on that currency. It's what they call forward guidance. So forward guidance tends to impact the currency quite dramatically occasionally. So I think that is focusing on that, and the developments for forward guidance is more it's more appropriate to keep an eye on and watch when you're trading certain currency pairs. Definitely for forward guidance.
And sometimes when it comes to central bankers, first of all, their compliance is so strict that every single word that comes out of their mouth definitely has been checked at least gazillion times. They have, studied the speech by heart. They don't slip really. Every now, okay, fine. Christine Lagarde has made a small error, I think, once when he said that they're not going to sacrifice the Eurozone for the sake of Italy or whatever, and she regretted it big time, right? But point being, every single word is really vetted, gone through so many checks, so you know what they want to say really is the thing that they are meaning. And sometimes you just have to see forest past trees when you talk and when you read about their statements. So
very much.
I think European Central Bank ECB just mentioned last week during their monetary policy statement that they won't be focusing that much on the yield, the 10-year yield within the Eurozone as such, but more the yield spreads. So what does that mean? You have to look at, for instance, the Bund and the Italy 10-year spread. So it's not the level of Italian spread as such, but it's the spread between the number of countries in the Eurozone. So these type of small things that they mention, I mean, they actually tell to the market what are the central bankers thinking. So for me, that is yield curve control in Eurozone going forward.
Yeah, I remember back a little while back, this is something for what Euro traders used to watch out for. It's when Mario Draghi, Super Mario, he used to do his press conferences, and he always used to say this one line, and he used to repeat it in every press conferences, and it always was considerable amount of time. And he was either like, we expect a dramatic downcline for a considerable amount of time, or we expect not to be able to do anything for a considerable amount of time. And they watched it, and they were watching out for what's going to follow before he says considerable amount of time, and that will mean it's hawkish or that will mean it's dovish. But yeah, that's an interesting little memory I remember of good old Mario Draghi. Another question.
But I'm just going to say it's a bit silly that we've come to this particular level that we have to have this, interpretation or whatever of the language. But, it's 2021.
People looking out for code words, aren't they? This is it, what they are, or hints. Another question here, which again, we can relate to currencies. What's the best times to trade?
Depends on the pair, depends on the currency. So for US dollar, I would say there isn't really the best time because it's such deep liquidity. But when you trade a currency that's maybe lower in volume, liquidity, and is specific to one particular time zone, I would trade that currency only within that time zone. So loonie during North American hours, Australian dollar during Asian hours. Euro, I think again better liquidity. Euro in European hours, but Euro is pretty widely traded. So I think there's no specific time. And those who have the volume charts available on their trading platform, they can see a bit of a spike at certain times. Let's say on the 4-hour chart, the 1-hour chart, you always see there's a bit of a spike at certain times, and that's when New York opens or London opens or Japan opens.
It's like the crossover sometimes with the US
European,
just crossover. Yeah. Okay, doke. That's a great question. So, like I say, in a nutshell, again, if you're looking at the Aussie or the Kiwi, look at the Asian session. Obviously, what banks are trading, what operators are, because they're awake during their Asian session, so they're going to be obviously a little bit more liquid. The dollar, like I say, as we already said, is the #1 reserve currency, so it's pretty much active. Cable, so not the cable, said the sterling, in particular, in the European session, clearly has a lot more volatility or activity because you have London open, Frankfurt open, etc. And the loonie, the Canadian dollar, North American session, because Canada has now woken up and in front of their trading screens.
Are they ever really fully up? Are they ever really fully up? Canadians.
I'm not going to say anything.
Love to all the Canadian viewers.
I have no doubt they are. Okay, as we wait for a few more questions, do you want to say what's coming up in the future, our next episode?
I'm going to ask you a question first.
Oh God.
Looking at GBP USD. So GBP USD currently trading at, let's say, 1.37000. Let's make it round, right? So we're trading at, let's say, swing highs that we haven't seen since April 2018. And this is happening at the back of significant economic slowdown. So we've seen GDP down, we've seen retail sales down 1.9% last year, unemployment rate 5%. So, James, what's your thesis? Why is GBP USD trading at swing highs?
Why is the cable still attracting the bulls? Is that what you think? Well, look, I tend to read my overall feeling of it. If I look at it on a daily, for example, let me have a little look-see.
If Mike wants to share my screen, then I do have this chart open at the moment, the daily GBP.
Yeah, bring it up. Let's have a look.
Let's jump a bit. So again, lots of stuff on my charts. Those people who know my charts, they know my charts.
Pretty colors.
Pretty colors. I love colors. Clearly,
I know, you love the rainbow, don't you?
I love the rainbow, and you see it's been trading in a very nice regression channel since September lows, near the regression line, within Bollinger Bands. It's honestly the most perfect bullish trend you can look at this.
Actually, look, the cable, in my opinion, I'm trying to look. Remember, we did the little show back in December, the end of year show. Do you remember this?
Of course.
Your cable predictions for May, and yours was 1.3154, and Yadi's won 1.4051, which was very bullish. I think the reason why we're seeing a bit of sterling strength, certainly against against the US, is the Brexit thing that's finally gone through. Even though, to be honest, there's a lot of things to be tied up. So they tend to feel a little bit of optimism that the UK can get things done quicker, like they are showing with the COVID-19 vaccinations. Are doing that, pushing a lot further ahead than Europe can. So I think there's obviously optimism that the UK might be able to, because face it, it can't get much worse in their opinion. So they're thinking that in the long run, the cable will end up being slightly stronger. Where I see this little bull run going at the moment, do I see it continuing? I see it continuing a little bit longer. And if I pull out a little bit, I'll give you, again, not advice, just my currently personal opinion. I can certainly maybe challenging, maybe if this momentum continues, maybe 1.4, like Riyadi said. But again, it really does depend on when reality hits in of obviously us leaving the EU. At the moment, there's optimism that we can get things done quicker, we can get some trade deals done, and that obviously we're then free to be a bit more competitive. Certainly our financial service industry can be a lot more competitive because we have to follow certain regulations. But the reality sets in is all not that great. I think it will then start to lose its momentum from there onwards. But anyway, that's just my opinion. What do I know?
I agree. I mean, I think valid assessments. I think also maybe the post-Brexit sort of appreciation may have been a bit too much. But I also I look at the chart. I have a weekly chart open here. It seems to me like a bit of the momentum is just fading away. I mean, looking at the ADX and looking at DMIs, I think the energy
Yeah.
is getting lower and lower. So
Yeah.
for me, I would probably I stick with my views that we're going to have weaker pound probably by Q4. But it's been, I mean, the chart looks beautiful again. I'm just lovely bull chart. Should be in a textbook to show how a bullish trend looks like.
Yeah, no, it's like I say, I think it's like everything. You know, once reality sets in, the inferior sort of peaks off, and people, you know, then I think obviously that will it may could likely potentially start to fade. Just looking at it on my chart as well.
So
you know, but
just for a data point, UK is expected to have the worst GDP growth, I guess, contraction among G7 countries. So OECD is projecting -11%. So definitely negative on that side. Services sector shrinking a lot, especially client-facing services, which was down 11.5% during December, which again is obvious because of the lockdown. But given that now I think 10% of population already being vaccinated and aiming to vaccinate 70% of adults by August, I think puts the UK in a pretty good place in terms of reopening.
Exactly, if they can do that, because don't forget the UK's main economy is its service industry. It's driven by that, and the fact that, I mean, they're not known for manufacturing, they're not known for their industrial thing anymore. It's a service industry, be it the financial services or the face-to-face service industry. If they can get people back face-to-face, like you rightly said, then clearly, obviously, there's the optimism that they will do a proper big recovery. And like I say, they are moving forward quickly with these vaccinations. It's a little bit, certainly quicker than their other European countries. So yeah, that could also be, you know, it's my opinion, is the reason why there is a little bit of bullish momentum with the cable. Let's have a quick look if there's any other questions from anybody at the moment. Not at the moment. Do you want to, should we say what we're going to be doing next? What's coming up soon?
Yes, opening up my calendar in parallel, since again my memory is not what it used to be. So we're doing sessions pretty much every Wednesday going forward. So regular viewers, they know. Hopefully they do sign up for those. Okay, my calendar is slightly slow, but it's open now. So next week, what we're going to do is we're going to have multiple time frame analysis, something that again is coming from our viewers who want to understand how to trade different time frames. Then we're going to have on the 10th, and then the subsequent Wednesday, we're going to do session 2 on our candlesticks. We're going to do session 2 on our patterns, and we're going to do application of both of these. So we're actually going to go find a chart when we can see a certain pattern or candlestick, and we're going to go that through in detail.
That's going to be brilliant. That's going to be a really good one, that one. So I seriously recommend everybody make a note of that one. That's on the 10th we're doing that one, yes? 10th of February?
Correct, 10th and 17th, yes. And please do give us your views. If you want to, you know, focus on certain topic, or whether it's fundamental driven or technical driven, please do let us know. Feel free to send us an email. We also have social media presence everywhere. So find us on, you know, all the places where young people go these days. Please submit your ideas and questions and comments and feedback. Those would be very much appreciated.
Always. And don't forget, we need your feedback, we need your questions and things like that, and your ideas for topics, because we make these little programs for you, and it's for your education, and whatever you want to learn, we're here to try and help teach you and share this information with you. So without you, we do have no show. On that note, today, unfortunately, we've only had those 2 questions which I had earlier, so we have no questions or follow-up questions for now. But if you have a question, come back next week and ask us again, and we're happy to answer it. On that note, would you like to say goodbye, Kaia?
Thank you, everyone, for joining. Always a pleasure. And we'll see you next Wednesday.
Absolutely. Now, remember, everybody, these little programs of ours are for educational purposes only, and no way or should be taken as advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you out there, trade safe.